Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is May the 11th, 2023. It is about 2:30 p.m. Central Time. The bond market and mortgage-backed securities still have about an hour and a half left in the trading day before we close. Now, I haven't been able to get this report out for a couple of days for most people because I've been pretty busy and traveling. So, yesterday, there was a huge report that came out, which was the Consumer Price Index reading for the month of April. Now, we have been watching for this report for a number of months. We've been talking about May 10th as a big day in the mortgage interest rate world for a while. That report did come out and it showed inflation subsiding, which we expected, but not as much as we expected it to come down. Unfortunately, it wasn't as powerful as we thought that it was going to be. Interestingly enough, one of the factors that they look at in the consumer price index is used auto sales, and it showed used auto sales having a pretty steep incline in costs, causing inflation on that item to go up, but it does shift the overall consumer price index because used auto sales is one of those items that they look at when they do the math on kind of what we talk about, that basket of goods that they're looking at. So interestingly enough, used auto sales kind of threw a wrench into the works. But inflation is coming down. Now today we got the producer price index. And if you remember, the producer price index is the cost of the goods that it takes to manufacture those items that are in the consumer price index report or the personal consumption expenditures report. So this is like a little further up the food chain, right? So this is, I always talk about, this is the chocolate that it takes to make the Snickers bar. Producer price index would measure the inflation rate of the chocolate. Consumer price index would measure the inflation rate of the Snickers bar. So that kind of explains that a little bit. Now, producer price index, take a look. Now, if you think that inflation is not coming down, get this. The producer price index report on the headline reading year over year at one point was over 11% inflation. Right now, as of today's report, the headline reading on an annual number for producer price index is under 3%. So if you don't think that inflation is subsiding, I don't know what you're looking at. However, again, the producer price index is kind of at the head, right? It's at the beginning of these changes. So the CPI and the PCE are going to follow. Inflation is coming down. Home loan interest rates are going to come down. It's just getting more of these reports showing the effects of the moves that the Federal Reserve has already made through the federal funds rate. Now, other information. After the consumer price index report that came out yesterday, we're starting to hear people talk about the Federal Reserve the next time they meet actually bringing the federal funds rate down. All we've been talking about for a couple of years now is how much they're going to bring it up. And then talking about when are they going to pause? Because usually it's up, 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 pause, and then they bring it back down. They're talking about, there's a matter of fact, there was 100% consensus of the people that were talked to yesterday that the Federal Reserve would bring the federal funds rate down the next time that they meet by 1/4%. I don't think they should. I think they should leave it alone. Don't make a change at all, not up, not down for a little while. Let things continue to sink in. Let the effects of the federal funds rate moves do its job on inflation, and maybe you begin to bring it down in the fall. But if they do, good for home loan interest rates, right? Because that is another competing factor when it comes to home loan interest rates, and it does affect home loan interest rates, but not directly control them. So where are we after all of that data? Where are we when it comes to our mortgage-backed security charts and our home loan interest rates? Let's take a look here and make sure that you do like, subscribe, and share, and hit that notification bell in the top if you want to be updated pretty much every day. I can't say every day, right? Missed 2 days, but pretty much every day on what's going on with home loan interest rates. Let's take a look at our charts. We're currently up 9 basis points on our mortgage-backed security that we watch out here, down 10 on the Treasury. Now, this is what we want. We want the mortgage-backed security to go up, and we want the 10-year Treasury to go down in the home loan interest rate world. Very important to see that we are sitting above this blue line, which is the 200-day moving average. This is good news. We were above it yesterday and we're above it today. Hopefully we will close above it because you all know in watching this show consistently, the 200-day moving average has been very difficult, not just to get above, but to stay above. And we need to stay above the 200-day moving average before we can again begin to feel more and more confident about the moves that we're going to be having here, which we will throughout the rest of the second quarter, going into the third, and even in the fourth quarter of this year as home loan interest rates come back down and we get out of the cycle that brought interest rates up. To take a look at the 10-year Treasury, which is very important and a really great indicator on what's happening with home loan interest rates, it also is well below its 200-day moving average, which, again, the 10-year we want to be down. So this is good to see below the 200 moving average, below the Fibonacci level here, banging up of this Fibonacci level at the 335 number, hoping maybe that we can break through that as well. Where are we on our actual interest rates? Well, let's take a look at our scenario here, which is our very well qualified 30-year fixed conventional home loan, 800 FICO score, 25% down. Going through us, we are mortgage brokers, so looking at multiple banks at the same time. These are not the interest rates that you're going to see with regular mortgage bankers. It's going to be higher because mortgage brokers traditionally have much less cost, which is why they're able to pass off lower interest rates. So hopefully this pulls up here in just a moment. Overall, again, we're going to see where we are today on our 30-year fixed mortgage. Okay, United Wholesale leading the pack here. Once again, you cannot get these rates without calling a mortgage broker such as myself or my company. 30-year fixed, 6.5%. Again, not that effective, right? What we have seen so far has not done a lot to the actual rate. I think it's because banks are still waiting to see what it looks like and waiting, kind of holding on to some of their revenue before they hand that off. So let's take a look and see what it takes to get down to that 5.99. So we're opening up the United Wholesale page. 5.999 is costing 0.599. So just over a half of a point right now to get to that 5.999. So we have seen improvement, steady improvement. If you watch this show consistently, you know that we were up really at a cost of about 1.9 to get to that 5.999 not long ago. Here's the parameters that we're taking a look at here today. So overall, home loan interest rates are coming down just slower than we wanted them to. Now, we still think that we're going to see some pretty dramatic moves coming out of the reports that are going to be coming out later on in the month. I will keep you posted on those as it goes. Let me know your thoughts. Let me know if you think I'm crazy, if you think I'm right, and I will get back to you again tomorrow.